the rebound we've seen from some of the sell-offs last week, once again, has got us back to within striking distance of new highs again. Do you, if you're an investor, do you keep what you have and add to it, or do you use this opportunity maybe to lighten up? Some people are de-risking because of escalations in the trade front. What would you do?
You know, we're staying put right now with our allocations. We acknowledge that there's quite a bit of risk out there. You mentioned trade, the yield curve. But as long as the consumer can stay steady, that we think that the U.S. economy will stay strong. And we think that will be a supportive environment for stocks.
Do you, I mean, I was reading about Boris Johnson and the Queen and everything else, and this makes it less likely that there's any type of deal. I mean, maybe there will still be one. Maybe it's a way to force the issue. But what if there's a no-deal Brexit on October 31st? Do you add in that to what could potentially, cause some de-risking?
Look, there's a lot of uncertainty out there, and the tweets are moving the market. I think that really the bigger concern, Brexit adds to the uncertainty. It could be a big drag for the UK, but we're more really concerned about what's going on with the tariffs. You saw today how the market moved with just some rhetoric out there that things are improving. With the tariffs coming online this Sunday, the consumer could be affected. And you've seen what's happened on the manufacturing side. When the tariffs started back in March of 2018, we've seen 15 straight months of declines in the global PMI. That's the longest streak in history. Now you're seeing some of these economies that have a heavier manufacturing tilt actually have negative GDP numbers. We saw that in Germany. And so the concern is that the manufacturing sector has been decimated. You've seen the first time that the manufacturing PMI went negative here. And so if this starts up on the consumer side, the consumer has been the linchpin for holding up the market. And even though the direct numbers aren't real big in terms of our effect on the economy, it's more about how the sentiment is affecting the consumer. And are they going to stop spending? Are we going to see companies actually, do less hiring, and then that translates into less spending for the consumer? So yes, Brexit, that's a concern. That's been out there a long time, but we're really concerned more about the consumer at this point.
Dr. Evil?
Okay, I'll take that moniker this morning.
It was just
I'll accept it.
You toss back, well, Voldemort, here's the answer.
Yeah, exactly. Give me the name that shall not be.
People dismiss the good retail sales numbers because they said they were kind of before the trade wars really heightened up and the tensions really ramped up. But we had very, very strong consumer confidence, and that already was for August, which reflected some of this. So there's a lot of strength out there. I think the opportunity is, frankly, to dial risk up a little bit. Particularly in small caps in the U.S. and emerging markets. Number one, they've gotten hit the most, since the beginning of May when these tensions started up. EM and small caps are off about 10%. The S&P's only off 1%. And those are the two pieces that have been historically the best beneficiaries of Fed easing cycles. So I'd put a little more risk on the table.
Yeah.
I mean, you're in charge, aren't you, at your shop, Simeon?
Well, we follow indices, but I'm certainly in charge of communicating how they all function and how they function.
And people need to do what you say. So what you're saying, what should I do right now? Am I adding? Am I buying? Where am I buying?
I think you're adding a little bit to the risky side of the equity markets because that's the cheap place.
That's not de-risking. That's risking.
No, I wouldn't de-risk in this environment because where would you de-risk to? Even in the bond market, so we've got this inverted yield curve, which I don't think says much about the economy because of all this QE, but you're not being rewarded for risk in the treasury market. Even on the bond side, I would tilt away from treasuries and towards corporates. The corporate curves are not inverted at all. There's almost 250 basis points between the 2s and 10s and high yield.
So do you take advantage of the yield in the S&P now, or is growth leads? When we're if we're setting new highs, I figure FANG and other growth stocks are going to be leading the way, aren't they? Or
the yield thing in the S&P is a little funny. Everybody forgets that 15 years ago we cut the tax rate on dividends, so that sort of long-run picture of yield is a little clouded. But specifically to your point, I would stay center of the style box. Kind of quality plus growth kind of strategies that don't tilt too far away into either corner of the style box, because value could be a perpetual value trap, particularly if you're looking at Europe as an example. Not only do we have the Brexit issues, but we also have very weak data out of Germany. But the extreme growth side is could be susceptible if there's any disappointment to growth numbers.